welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss market expectations for Fed funds rates. And Michael, as we could see here in this first chart, it seems to be a bit all over the place considering the data that we've had coming in.
Right, so there's been a big shift this month. At the start of the month, the Fed hiked rates 25 basis points to 4.75%. And since then, market expectations have been ratcheting up with each subsequent data release that came in, showing that the economy looks stronger than we thought it had been. So if you take a step back and look at where we were for November and December, we had, the labor market was still strong, jobs were added and coming in a bit higher than forecast, and inflation was trending down pretty nicely. But then we had negative month-on-month retail sales and manufacturing industrial production. So some signs of weakness going into the end of the year. But then when we got the January data, which of course came out in February, we added 517,000 jobs in January, which was more than double what was forecast. And then when CPI data came out, it came in line with forecasts, but it's not falling as quickly as it had been prior to that. And then again, with retail sales, we saw that jump 3% month on month when the forecast was about 1.8%. And also manufacturing industrial production rose 1%, which was also higher than forecast. So there was a lot of strength in the data with all of them kind of coming in higher than expected. And so we saw, market expectations for the peak Fed funds rate move from about 5% in May or so, all the way up to about 5.5% in late summer sometime. So that's a big shift for just a 3-week period.
Yeah, it really is. And I think what's even more interesting is the divergence that we're seeing in equity and bond performance. Both markets seem to be telling you something very different with how it's interpreting what the Fed is going to do next.
Right. I think the most straightforward was the bond market, where you saw 10-year yields rise from about 3.4% at the start of the month to about 3.9% now. And so that's a big reaction to 50 basis point move in market expectations for the Fed funds rate, to see a similarly sized 50 basis point increase in a 10-year yield. But for the S&P 500, for example, it held up pretty decently through most of the month, but in the last couple of days it started coming down, and it seems like maybe the totality of the data finally got through to the equity market, where it's clear that the economy is stronger than we had thought, and we've had Fed officials talking about the need for more rate hikes as well. So that coming through, plus of course, the equity market may be more sensitive to earnings news that's been coming out now too. So all told, we have S&P about 5% down from its peak earlier this month.
Why do you think there was such a different read in the market from the equity market versus the bond market? It feels as if the bond market is kind of processing what the economy and what the Fed is clearly telegraphing, and the equity market just wants something totally different.
Right. Yeah, I think perhaps it's some more hopefulness in the equity market there, and it looks like the earnings data that we have gotten, it's still negative for the fourth quarter of last year, but that's what's being reported now. But it's not quite as negative as it had been a couple weeks ago. So there could be some improvement there on top of this data. It is very strong, so you're getting this. It's kind of two sides of the same coin, where you have a strong data, so that requires potentially more hikes from the Fed. So it's kind of weighing how those two things will even out.
I wonder if the equity market's taking a step back, because this week we're getting the real big names, the Walmarts, the Home Depots, with consumer earnings, and a bright spot has been the strength of the consumer. So I wonder if the equity market is thinking, okay, perhaps it's not quite as bright as it might have been because retail earnings have not been good.
Right, true. Yeah, that makes sense, and it could be a reason why, even though we have a 3% month-on-month retail sales number, if Walmart's saying that we had a good fourth quarter, but looking ahead we're not as sure about it, then maybe that helps markets think a little bit further ahead of where the Fed is going and could kind of cool off a bit there.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.